Looking to pick up cheap shares after those shares have dropped in price by 50%? Does a 5% yield and a double-digit dividend growth rate sound enticing to you? Interested in investing in an under-the-radar business that has been thriving? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a leading retailer selling a variety of consumer electronics and appliances. What do we know about Americans? They love their electronics. Just take a look around. People are glued to their screens, be it a smartphone, a television, or a computer. That's just reality. Well, this company profits handsomely from that reality by selling the products people want at the price points they demand through the channels they frequent. This has led to the business reliably increasing its revenue, profit, and dividend. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Best Buy Co. Inc., which appear to be trading at a significant discount today. Best Buy Co. Inc., stock ticker BBY, is a North American consumer electronics and appliances retailer. Founded in 1966, Best Buy is now a $16 billion by market cap retail giant that employs approximately 100,000 people. The company operates over 1,100 stores across their North American footprint, most of which are in the United States. Results are broken down across two business segments, domestic 92% of fiscal year 2022 revenue, and international 8%. The company's revenue mix has five major categories: computing and mobile phones 42%, of Q4 fiscal year 2022 domestic revenue, consumer electronics 34%, appliances 13%, entertainment 8%, and services 3%. Best Buy has surprised a lot of industry watchers over the last 10 years, thriving in an environment in which a lot of old school brick and mortar retailers have struggled or closed up shop altogether. Retail in the US has been devoured and commoditized by mass merchandisers intent on taking maximum market share at all costs. With the US arguably being oversaturated with B&M retail in general a decade ago, and the e-commerce space still being relatively nascent at the time, the retail landscape was ripe for change. Best Buy, as a legacy B&M retailer in a world becoming increasingly digital, could have easily turned into yet another cautionary tale. Instead, they turned into a success story. Making matters even more impressive, Best Buy has largely done this by selling consumer electronics, prime products for mass merchandisers to take market share in and sell online. How did this happen? Well, I believe that leaning into the niche accounts for some of the success. A consumer knows exactly what to expect from Best Buy, and it's top of mind for a lot of consumers when they're in the market for electronics. But something far bigger is at play here. Best Buy has thrived by adopting an omni-channel retail approach, which means they meet the customer wherever the customer is. They built up a potent e-commerce platform before the pandemic hit, putting them in a position to compete against the online onslaught. This proved to be prescient as the pandemic severely curtailed in-store interactions. To offer some perspective on just how critical this was, digital sales as a percentage of domestic sales have gone from 19% in fiscal year 2020 to 39% in fiscal year 2022. Selling the specific product consumers want at the price points they demand across the various channels they frequent has been a long-standing recipe for Best Buy success, and I think that'll remain so. That should translate to to the company being able to continue growing its revenue, profit, and dividend for years to come. As it sits, Best Buy has increased its dividend for 19 consecutive years. That's actually fairly impressive. 19 years is a long time in Best Buy's retail world. The 10-year dividend growth rate is 15.8%. This is also impressive in my opinion. Better yet, there's been some recent acceleration in the dividend growth rate. The most recent dividend increase came in at over 25%. Now, I wouldn't expect that to persist. Best Buy has been a beneficiary of some pull forward in demand stemming from pandemic-related trends, which saw people load up on goods like computers and TVs while they stayed and worked at home. These trends are temporary. As such, I would expect the near-term dividend growth story here to be somewhat modest as the numbers become right-sized to a new reality. On the other hand, the market has already adjusted for this. You see that show up in the stock's yield, which is now 5%. That's 3 times higher than the broader market's yield, and it's 250 basis points higher than its own 5-year average. This high starting yield, twice as high as it normally is compensating today's investors for a possible slowdown in dividend growth over the next year or two. A payout ratio of 40.5% based on midpoint guidance for this fiscal year's adjusted earnings per share shows a perfectly healthy dividend, but the payout ratio could rise if Best Buy drops its outlook in the face of tough year-over-year comps and a deteriorating environment. For income-oriented dividend growth investors, a well-covered 5% yield is captivating. Looking at business growth, I almost always use a 10-year snapshot of top line and bottom line growth using a full decade as a proxy for the long term. I think that gives us a reasonably accurate picture of what a business can do over the long haul, smoothing out short-term fluctuations. However, in this case, I'll be using a 9-year period from fiscal year 2014 to fiscal year 2022. That's because Best Buy initiated a program they called Renew Blue in late 2012. It was designed to fix shrinking margins and declining same-store comps. This program resulted in a slate of changes, including the sale of non-core assets. A major sale was the 5-star business in China, which led to Best Buy completely exiting the Chinese market. Fiscal year 2014 represented the first full year of the Renew Blue transformation. Best Buy increased its revenue from $42.4 billion in fiscal year 2014 to $51.8 billion in fiscal year 2022. That's a compound annual growth rate of 2.5%. Meanwhile, earnings per share grew from $1.56 to $9.84 over this period, which is a compound annual growth rate of 25.9%. You sometimes have to shrink to grow. Best Buy clearly did just that. The Renew Blue program created a smaller but more focused and faster growing base. The transformation has been remarkable. To wit, comps have gone from negative 1.7% for fiscal year 2012 before the program went into full effect to 10.4% for fiscal year 2022. Net margin went from below 0% in fiscal year 2012 to nearly 5% for fiscal year 2022. Extensive buybacks have also helped to drive a lot of the excess bottom line growth we see here. For perspective, the outstanding share count has been reduced by approximately 28% over this 9-year stretch. Looking forward, CFRA believes that Best Buy will compound its earnings per share at an annual rate of 3% over the next 3 years. This would represent a severe drop in earnings per share growth relative to what Best Buy has enjoyed over the better part of the last decade. I think it's incredibly difficult to forecast growth in this unique environment as we have an unprecedented mixture of rising rates, high inflation, looming recessionary risks, and falling demand for consumer electronics after a once-in-a-century pandemic caused a pull forward in sales. It's important to recognize that the last 2 years do not make for accurate or sustainable measures of the company's long-term prospects. All the same though, I don't think what will happen over the next 2 years will be accurate or sustainable measures of the company's long-term prospects. The global economy will normalize in time and the business will see its numbers right-size themselves as it adjusts to the new reality. Overall, I think it's prudent to consider performance before the pandemic hit. They were growing earnings per share at a double-digit clip annually, which is why you see the long-term double-digit dividend growth rate. It's certainly possible, if not likely, that Best Buy is only able to muster up low single-digit earnings per share growth over the next few years. They're coming off of a high base, which was supercharged by the pull forward in sales, and near-term sales will be cooled by that very same pull forward in sales. What the pandemic giveth, the pandemic taketh away. However, I don't see why this business can't get back to at least high single-digit bottom line and dividend growth once we're out of the woods and the storm clouds pass. When you're starting off with a 5% yield, the stock offers plenty of current income to placate long-term dividend growth investors while they wait for sunny skies to return. Moving over to the balance sheet, the company has a terrific financial position. The long-term debt-to-equity ratio is 0.4, while the interest coverage ratio is almost 122. Furthermore, total cash is enough to pay off all long-term debt debt twice over. Profitability is robust and it's been moving in the right direction. Over the last 5 years, the firm has average annual net margin of 3.6% and annual return on equity of 44.4%. Best Buy has made the difficult but necessary pivot into a successful omni-channel retailer, meeting the customer wherever they want to be. Simultaneously, they improved the business across the board, which has led to margin expansion and better comps. And with economies of scale and brand recognition, the company does have durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. Retail in particular is notoriously competitive. Best Buy competes mostly on price. Margins could be squeezed in the future. The company will have to continue adapting and pivoting as the constant evolution of retail plays out. The risk is that they find themselves unable to do this at some point. There's uncertainty regarding how much of a pull forward in sales has occurred over the last 2 years. Investors are operating somewhat blindly over the near term. Best Buy is largely dependent on sales of electronics that are often discretionary in nature. Any economic downturn would almost certainly reduce demand for these products. The improvement over the last decade has been impressive, but it could also prove to be an aberration. Comps and margins are both healthy right now, leading to less room for improvement on a go-forward basis. I think it's vital to carefully weigh these risks, but the valuation weighs heavier to me. With the stock down a stunning 50% from its 52-week high, it looks extremely undervalued now. The price-earnings ratio is 7.7. This is about half that of the stock's own 5-year average PE ratio of 15.1, which in and of itself is undemanding. A single-digit PE ratio is usually absurd, but it's especially so for a company that's demonstrated an ability to grow at a double-digit rate over a long period of time. While we can all acknowledge that the E in this ratio will come down in the near term, the P side of the equation has adjusted in advance. Could earnings drop in half compared to fiscal year 2022? I suppose that's possible, but the stock has already been cut in half. Indeed, the stock was priced at similar levels to this back in late 2017 when earnings per share was less than half that of what it was for fiscal year 2022. The sales multiple is also low, with the price to sales ratio of 0.3 well off of its own 5-year average of 0.5. And the yield, as noted earlier, is substantially higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 6.5%. This dividend growth rate is very conservative when you compare it to what this retailer has done over the last decade in terms of both earnings per share growth and dividend growth. And as I stated above, I see no reason why Best Buy can't get back to at least mid-single digit growth once the world gets back to some semblance of normal. However, I'm also keenly aware of the near-term uncertainty. We're in an unprecedented environment. I think it makes sense to err on the side of caution in this kind of environment, but I also think we shouldn't lose sight of the long-term picture. It's easy to be negative in the here and now, but this valuation model is most useful when one broadens their perspective. I see this as a conservative hurdle for the business to clear, even if the next year or two is difficult, setting up Best Buy to over-deliver when we start looking out over the next 5 to 10 years and beyond. The dividend discount model analysis gives me a fair value of $107.11. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Best Buy as a 5-star stock with a fair value estimate of $126. CFRA rates Best Buy as a 3-star hold with a 12-month target price of $84. I came out almost exactly in the middle this time around. Averaging the three numbers out gives us a final valuation of $105.70, which would indicate the stock is possibly 51% undervalued. Here's the bottom line, guys. Best Buy Co. Inc. is a great business that has thrived in a very challenging and competitive environment. They successfully pivoted into an omni-channel retailer, massively improving along the way. With a market-smashing 5% yield, a healthy payout ratio, nearly 20 consecutive years of dividend increases, double-digit long-term dividend growth, and the potential that shares are 51% undervalued, this could be one of the best deals I've ever seen for long-term dividend growth investors. And now for a special news announcement. Apple Inc., stock ticker AAPL, is added again. CEO Tim Cook, in an interview with China Daily, said, "Stay tuned" when talking about their potential in the augmented reality space. For a company that's typically very tight-lipped he may as well be screaming that they're going to be soon launching an AR product. I've discussed Apple's possibilities in the AR, VR space to the point of ad nauseum, and I've called this a must-own stock for serious long-term dividend growth investors. Apple might not be the first in any given market, but they tend to do it best when they arrive. Don't forget about or underestimate this world-class business. Thanks so much for watching. Hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you can benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.